welcome. We want to continue with our revision as far as the group or consolidation accounts are concerned. Remember, friends, we have been looking at this chapter for a long time now. We talked about a scenario where one company acquires the shares of another company. We looked at where a company will acquire more than 50% of the other company. That is where the second company becomes a subsidiary. We also said in a case where one company acquires less than 50% shareholding in another company, but more than 20%, the other company becomes an associate. We also talked about a case where there is a joint control or where they have equal rights of another company, then that becomes a joint arrangement. We talked about where there is less than 20% shareholding, the other company becomes a simple investment. So we'll continue with our revision today. And friends, today we want to look at a revision that is concerning both a subsidiary and an associate. Now, as we must have said, we want to look at a question that was examined in December 2014, and that was a question 3. Here it goes. Hearst Limited purchased 80% of the ownership capital of Sharp Limited on 1st August 2014 for 496 million shillings and 20% of the ownership capital of Allen Limited on 1st February 2014 for 56 million shillings. The following income statement relate to the 3 companies for the year ended 31st October 2014. We have revenue, we have for Hearst, Sharp and Allen, we have the cost of sales, we have the gross profit, we have the distribution cost, we have administrative expenses, we have the finance cost, we have the profit before tax, we have income tax and profit for the period. Additional information number 1. The retained profit brought forward as of 1st November 2013 and the ownership capital for the 3 companies as of 31st October 2014 were as follows. We have been given for Hearst, Sharp and Allen, as you can see yourselves. We have the retained profits brought forward. We have the ownership capital. Number 2. On the date of acquisition of Sharp Limited, the fair value of non-controlling interest was 109 million shillings. Hearst Limited estimates that as of 31st October 2014, 6 million shillings and 2.4 million shillings of the goodwill arising on acquisition of Sharp Limited and Allen Limited respectively have been impaired. During the post-acquisition period, Hearst Limited sold goods worth 200 million to Sharp Limited at a profit margin of 25%. A half of the goods were included in the inventory of Sharp Limited as of 31st October 2014. Required A. Consolidated statement of comprehensive income for the year ended 31st October 2014. B. Extract of the retained profits portion of the statement of changes in equity for the year ended 31st October 2014. C. Computation of goodwill arising from acquisition of Sharp Limited and Allen Limited. Now, friends, from the required point of view, we can see part A, we are required to prepare a consolidated income statement or the statement of comprehensive income. Remember, we have 3 companies here. We want to know whether Hearst is the holding company. We want to know whether Sharp is the subsidiary or an associate. We also want to know Allen is a subsidiary or an associate. We know we have been given such information, but we are coming back to that. Then we have been told in required number B, the extract of the retained profit portion of the statement of changes in equity for the year ended 31st October 2014. We have also been told to compute goodwill arising from the acquisition of Sharp Limited and Allen Limited. Remember, friends, if one of them is an associate, we are not going to compute goodwill. We could have said that we are computing the premium on acquisition of Allen Limited or Sharp Limited if they are an associate. Fine. you need to remember, if you're going to prepare a consolidated statement of comprehensive income, we need to consolidate the incomes and expenses of the holding company and subsidiary. In case of an associate, we only bring in one main item. That's the group share of profit after tax in an associate. We don't consolidate the revenues, expenses of an associate as we do for the holding company and subsidiary. For the purpose of our group income statement, remember friends, I'm repeating this again, we will take the sales, or revenues, expenses of the holding company and of our subsidiary. But in case of an associate, we only bring in the group share of PAT in an associate. However, you also need to remember that if you're going to prepare the group statement of changes in equity, if we had acquired an associate many years ago, then we need to bring in as well the group share of post-acquisition retained earnings brought down of an associate. So don't forget that we must have talked about this, the format of an income statement or consolidated income statement some time back. I may want to go back to that, but maybe we may not to because we have done it before. Okay, now I'll go back to the information, analyze it, explain it before we do it. From the beginning of the information, we have been told that Hearst Limited purchased 80% of the ownership capital of Sharp Limited. This means, friends, that Hearst is actually the parent or holding company, while Sharp Limited is a subsidiary. If we own 80%, then the 20% belongs to outsiders known as non-controlling interest. Then we have been told that we acquired Sharp Limited on 1st August 2014. Remember, we are preparing our financial statements on 31st October 2014. So if you look at that very well, friends, from 1st August 2014 to 31st October 2014, it makes 3 months. That's 3 months being August, September, and October. So the post-acquisition period, as far as Sharp Limited is concerned, is 3 months. Now, you need to remember this, friends. At any point in time, the post-acquisition period is less than 12 months in a subsidiary, then the incomes and expenses of the subsidiary must be apportioned on time basis. We also apportion the profit attributable to NCI on time basis to reflect the post-acquisition period only. Then we have also been told they acquired for 496 million. That is the purchase consideration. The purchase consideration, friends, is going to help us to compute the goodwill in Sharp Limited. Then we have told that 20%, Hearst Limited acquired also 20% of the ownership capital of Ale Limited. In this case, friends, Ale Limited becomes an associate. We acquired this on 1st February 2014 for 56 million. We also acquired Ale Limited as an associate in between the current year. This means the post-acquisition period in an associate, friends, is less than 12 months. As we are going to bring in the group share of PAT in an associate, we are only going to bring in the post-acquisition element. Meaning, we'll take the group share of PAT in an associate, but for only post-acquisition period. Now, from 1st February 2014 to 31st October 2014, friends, as we can see, that makes it 9 months. So, we are going to apportion the group share of PAT in an associate for 9 months to be reported in our group income statement. We have been told the purchase consideration of 56 million that are going to help us to compute the premium on acquisition of an associate. Now, we have been given the income statement. The income statement given is for the year ended 31st October 2014. As we must have confirmed, our year begins on 1st November 2013 and ends on 31st October 2014. We have the revenue. We are going to take the revenue of Hearst and the revenue of Sharp. But the revenue of Sharp, remember friends, will be apportioned on time basis to reflect the post-acquisition period. Then we must subtract the intercompany sales. Don't forget that. We have the cost of sales. We'll take the cost of sales of Hearst Limited plus the cost of sales of Sharp. But remember still, the cost of sales of Sharp will be apportioned on time basis to reflect the post-acquisition period. Then we need to also adjust the group cost of sales with the intercompany sales. We also adjust the group cost of sales with the unrealized profits on closing stock. We also adjust the the cost of sales with the unrealized profits on open stock, not forgetting a depreciation and a charge or a depreciation of a charge in the year. We have the distribution cost. We'll take the one for Hearst. We also add the one for Sharp. But remember, friends, the one for Sharp will be apportioned on time basis to reflect the 3 months. We have the finance costs, and admin expense will behave the same way as distribution costs. Then there is profit before tax, that's okay. We have income tax expense. We'll take the tax expense of Hearst plus the tax expense of Sharp. But the tax expense of Sharp, remember, will be apportioned on time basis to reflect the post-acquisition period. Then the profit for the period, which is profit after tax, we are going to take the profit after tax of Allen. So we'll take the 20% of the one for Allen, but we also apportion it on time basis to reflect the 9 months being the post-acquisition period. Additional information. Number one, the retained profits brought forward as at 1st November 2013 and the owner's share capital for the 3 companies as at 31st October 2014 were given as follows. We have been given for Hearst, Sharp, and Allen. Retained profits brought forward is given. Now, friends, the retained profit brought forward is going to help us first to compute the pre-acquisition retained earnings for Sharp. We also need the pre-acquisition retained earnings for Allen. This is mainly for computing the goodwill and premium on acquisition of Sharp and Allen. Secondly, the retained profit brought forward is going to help us in preparing our statement of changes in equity for the retained earnings column only. Then we have been given the owner's share capital. That owner's share capital, especially for Sharp and Allen, is going to help us to determine the net assets acquired for the purpose of computing goodwill and premium in Sharp and Allen respectively. Then number 2, on the date of acquisition of Sharp Limited, the fair value of non-controlling interest was 109 million. Hearst Limited estimates that as of 31st October 2014, 6 million and 2.4 million of the goodwill arising on acquisition of Sharp Limited and Allen Limited, respectively, have been impaired. Now, this information, no number 2, means that we are actually determining or accounting for goodwill using the fair value method. Under the fair value method, we not only compute goodwill attributable to the holding company, but we also compute goodwill attributable to the NCI, that's the non-controlling interest. So we are going to compute that because we have been given the fair value of NCI or non-controlling interest at the date when we acquired. We have also been told about the impairment loss, and it means we are going to account for that accordingly. 3, during the post-acquisition period, Hearst Limited sold goods worth 200 million to Sharp Limited at a profit margin of 25%. A half of the goods were included in the inventory of Sharp Limited as of 31st October 2014. This indicates that there is an intercompany trading. One group member has sold some goods to another group member. Now, first and foremost, when you're going to prepare our group income statement, we are going to have revenue for the holding company plus the revenue of the subsidiary. We subtract the intercompany sales. The intercompany sales in this case, friends, is 200 million. Then secondly, we are going to determine the unrealized profits. Now, the unrealized profits in respect to this case is as at 31st October 2014, meaning this is the unrealized profits at the balance sheet date. This is the closing unrealized profits. In this case, when you're going to determine the cost of sales, we are going to take the cost of sales of the holding company plus the cost of sales of the subsidiary. We subtract the intercompany sales. We also add back the unrealized profits on closing stock. Not forgetting, we'll also want to confirm whether these unrealized profits was due to a downstream transaction or upstream transaction. Did the holding company sell goods to the subsidiary, or is the subsidiary who sold goods to the holding company? If the subsidiary sold goods to the holding company, then we must adjust the profit attributable to NCI with the unrealized profits on closing stock. Let's confirm that. We have been told Haas Limited sold goods to worth 200 million to Sharp Limited. This means that it's a downstream transaction and is not going to affect the profit attributable to NCI computation. Friends, we have no other business but to go directly and work on this business. Let's move on and prepare our group income statement. Now, let's look at So we look at this question. It is a December 2014, question 3. Now we start off, we want to answer part A. Part A. We have, this is Haas Limited. Group income statement for the year that first 2014. So as we must have said, friends, we start off with our sales. Sales, we take the one for Haas, that is 2346, plus the one for Sharp. But remember, Sharp was a subsidiary during the year for only 3 months. So we take 3/12 of 2,400. Friends, at the same time, we also remember that in note number 3, we were told about intercompany sales. Intercompany sales is 200. Then we'll get that figure. So I take my calculator, friends. I come and say, this is 2346. We add, that is 3/12 by 2,400. We subtract 200. We get 2746. Then I move on to our cost of sales. In our cost of sales, we less cost of sales. Our cost of sales, we say, there is 1564 plus there is 3/12 for Sharp and 1620. You subtract the 200. We are going to add the unrealized profits on closing stock. Friends, the unrealized profits on closing stock, we were told that the selling price is 200, and we are selling this as a profit margin of 25%. So simply, if the profit margin is 25%, and normally the gross profit is on sales, if the gross profit is on sales, we simply take the gross profit margin by the selling price to determine the profit. So the profit, the total profit, is simply 25% being the gross profit by 200. That is 50. We have been told that a half of the goods were included in the inventory of Sharp Limited.